So I see this question, and I think a lot of people get confused with the call and the covered call and what the difference is. So I'm going to show you, I talk a lot about the wheel and covered call and stuff. So this time I'm going to show you guys, when do you start making money with the call? Because it's kind of the opposite of the covered call. All right, so we're going to use HIMS. It's different than HERS. This is the 2x leverage because I just like trading 2x leverage. We're going to do 18 call, okay? Right now the current price is $18.67. 7/18, July 18th is the expiration. Okay, that's like, I don't know, 3 weeks out. Actually less, maybe 2.5 weeks out. 335 is the premium. So it's actually $3.35. All right, so how this works is so the call is 18. The current price is 18.67. So we'll assume here. And then you paid premium. This is going to be a buy a call, not a sell a call. You sell a covered call, which means covered just means that you own 100 shares. That's okay, but you sell a covered call. You buy a call, meaning that you think that this is going to just go up, 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 and you have basically unlimited upside potential until you sell, basically. But you want to make sure like this kind of goes to like Bollinger Bands and RSIs. So like if this is like a 30 RSI and you're like, all right, I trim out at 80, this might be like an 80 RSI, like way out here. You guys have to do your own research because I do not specifically trade this. I'm just demonstrating to you how this works, how a call works, okay? So this is our strike, 18. This is the current price right now, as of making this video, because I just looked. It's going to cost you $3.35 or $335. You're going to pay that to take this trade because you don't own the shares. And you are going to give that. You're going to pay this to someone who is doing the covered call because the covered call is the inverse of this. Essentially, the covered call is the guy that has, guy or gal, that has the shares, say at 19, and they don't think it's going to go past 19, and they want your premium. They collect your premium for selling the covered call. They're selling you the option. You are buying the option. That's all that is. So in actuality, what it is your break even ends up being 21.35, which is way up here. If for some reason, right, this price falls down, the only thing you're going to lose is the 335. If it falls down below this number, 21.35, okay, which is, it's this number, your strike, plus that number equals this number. Anything below this number, you are losing your premium. So your max, this is your max loss, is the premium you pay up front to take this trade. That is the max loss. Your max gain is anything above this, is this area right here. This is all profit. But again, depending on how you trade, you might go, I'm looking for 70 RSI, 80 RSI. All depends on how you guys trade. That's pretty much the extent of it is you're just looking to go, all right, if it's trading at this number, I think, and by expiration, okay, 718 in 3 weeks, that we are going to go from this number maybe to 22. Anything above this number, you start making money. But again, it's your strike plus the premium you paid equals your cost basis. Anything above your cost basis is money to be had, okay? That is a call in a nutshell. And yes, this is a live trade. I just looked, all of these numbers are accurate. I just looked them up right before I made this video so I can give you guys exact data. This is not guesswork. I actually did the work. But I specifically chose this one because there was a great buying opportunity the other day, and because it fell significant, HIMZ, which this is the 2x leverage, so it fell by 2x down. Great buying opportunity, great selling opportunity. This is a great, if you guys are doing options, highly suggest looking at this. So that's it. This is the call option. This is like long. This is bullish. You're thinking that it's going to go maybe to 40, 50, whatever you think your target range is by expiration. Okay. If it doesn't break this number by expiration, you lose your money. I mean, you have to give it up. You have to give it up at the beginning anyways, right? So it comes out of your account, but this is the max you can't lose any more than this. Okay. So that's important to keep in mind. All right. And that's the call strategy. And remember, it's the inverse of the covered call. So you're essentially paying someone your premium. They get it up front. You lose it up front. They get it up front. But you might be able to get their shares and run it up. You might get assigned, and they might lose their shares because they're using their shares as collateral for you to take this trade. That's all it is.